Everybody, this is Jason Matthews with Matthews Financial Insurance Solutions and President and CEO of Gibson Monroe Wealth Advisors. Welcome to our April monthly economic and market recap. So much is happening right now. So much has happened today, yesterday with the news of First Republic Bank. I will dive into deviate from this as well. I want to definitely thank my team where every month we put together a plan recapping all the economic data that happened last month. And right now is a very, very interesting time right now in the market. And a lot of this we discussed in our book, The Age of Self-Reliance. Back in 2008 about what was going to happen. In my book, I talked about what's going to happen when we take away the punch bowl. And we have taken away the punch bowl, and we're seeing the ramifications of that right now in the banking world. So before we get started, let's go ahead and dive in. Once again, like I said, my name is Jason Matthews. Thank you for getting onto our call, into the Zoom, onto the Facebook. If you're listening to Facebook, if you're listening to Facebook, YouTube, anywhere in the world, TikTok, where we want to just thank you for getting on this, because I think this is very, very interesting times that we are in right now. And we just want to make sure that the American people can make the best decision for them, their family, their business, and community about what's really going on right now in the economy. So before we get started, let's into the market. Let's start off with the stock or equities market. So last month, when we talked about the stock or equities market, the Dow Jones average last month was up 2.48%. Remember, the Dow Jones average is just those big 30 companies that we hear about all the time. S&P 500, which is the 500 biggest publicly owned companies in this country, was up 1.46%. And the NASDAQ, which is the tech index, was up 0.1%. So that was actually really good for all three of them. For the month, the Dow saw its largest monthly gain since January. So that was really positive news for them in January, while the S&P logged in the second positive month. So what's happening right now? We're hearing talks of all this craziness and mayhem, but when we look at the three major indexes, they were actually positive for this month. We see that NASDAQ was positive, which we haven't seen in a while. We see that S&P up for a couple of months. And so those were great news. And then last Friday, the last trading day of the month, we saw solid gains through the strong series of the Dow Jones, S&P, and the tech. So to date, over 53% of S&P 500 companies reported earnings. Of those, 79% of them exceeded expectations of earnings per share, and 74 have beat their revenue expectation, which is this. Right now, when we look at the S&P 500, these 500 companies, their numbers are better than what they thought it was going to be, which is really, really, really interesting right now, especially when we see the market like today, where today we had a lot of volatility happening in the market, where the market dropped 1% in all three major indexes. And we're not sure what's going to happen tomorrow or the next day, but we know all three of them dropped 1% due to the debt ceiling, news about banking. As we all know, First Republic just got bought yesterday or over the weekend by Chase Bank, which I personally think is a bad thing, especially for us in the Bay Area when it comes to being a U.S. consumers. The reason why I think it's a bad thing is this. There's a couple of things. And the reason why, before I go deeper into this, I think it's a bad thing is this. One, it gives the consumer, the businesses, less options of banking they can go to. Right now, we're consolidating again less and less banks, which give us less and less options. So when it comes to lending, when it comes to banking, we're going to have less options to go to, which is always bad. We always like to have options in life. I tell my son, when we go to school, you want to get education, you want to make money, so you got options in life. And unfortunately, when you have less and less banks and lending, you have less options in life. Also, in 2008, what we said back then was that certain banks were too big to fail. And what just happened? We just made JP Morgan Chase, the biggest bank, even bigger as well. So if they don't do proper underwriting, we're going to have to bail them out with an even bigger check than we did in 2008, or we have done so far with bigger than Citizen Bank, with Silicon Valley Bank or First Republic Bank combined. So those are really, really interesting times right now, what we're seeing with all this information about what's happening with them. And so when we go back and we look at everything right now, we know that we see this and we're very worried right now because we know that banking is going to have layoffs. I just came from one bank that actually just had layoffs with, or not had layoffs, but they're closing their branch end of this month because Union Bank and US Bank merged, and not Bank with Union Bank, but they're merging. So you're not going to have as many of those branches that were right close to each other. They're closing. But let's go deeper into the jobs report for April, because I know I talked about layoffs, but let's look at this. So the job growth has been dropping for the last 3 months. So in March, which came out in April, the numbers were 236,000. In January, we had over $500,000 job growth. So the job growth is slowing down. And more we're hearing about this slowdown. We're hearing about people, this war of recession, and the economy slowing down. And so people are very worried about that at this moment. Right? Whoops, we lost contact with that. So then the next thing we look at right now, when we look at that, is GDP. So when we look at GDP right now, right, when we look at our GDP numbers right now as we speak, GDP has slowed down from quarter three. So quarter three was 3.2, quarter four was 2.6, and now it's 1.1. And because of that, what we're hearing right now is more and more of the word stagflation. And what stagflation means is when you continually see inflation, but your economy is slowing down. The problem with stagflation is this: the way that you traditionally fight inflation is by raising interest rates. And the reason why you raise interest rates is because you want to slow down the economy, because it costs more to service your debt or to buy things on credit. But if you want to stimulate the economy, you want to lower interest rates and print more money. Well, those are very conflict of interest, so it's hard to actually do both at that period of time. So you're hearing more and more when you're watching CNBC, you're watching Bloomberg, about stagflation. But now let's talk about what we've always been hearing, right? Which is the Feds and the federal interest rates. So the Feds had dropped plenty of breadcrumbs as they plan to raise the benchmark on April 22nd, 23rd. So today they had the Fed's meeting. Tomorrow we're going to hear an announcement of what we're estimating to be 25 basis points. With that, the Fed's fund rate is going to be 4.75 to 5%, which is totally different than what we saw a year and a half ago during the era of COVID. The era of cheap free money that we have from 08, 09, I should say, to now to 2021 is officially over with. So there's an 88% that the investors and economists think those rates are going to go up to that much. But many anticipate a pause in interest rate hikes the second half of the year. So what people think is that the Fed's going to raise it for this last time. And then we're going to pause, we're going to sit back, and the Fed's going to look at the economic data to really see if we're still having inflation or it has inflation constant or slow down. While inflation is still the main driver of Fed rate hikes, it has been for the last 9 meetings. Our central bank right now is really monitoring these banks. I know JP Morgan's talked today, said this is the end of the banking crisis. Well, they said the same thing here in Silicon Valley Bank. Well, since Silicon Valley Bank, we have First Republic Bank who failed, because banking at the end of the day is all about trust. And when people don't trust that they can get their money back from the bank, that's how bank runs happen. And that's the fundamental of banks. And the thing is, as soon as you give your money to the bank, you're lending that money. And that bank has to be responsible on how they lend that money. Understand that some people are going to need that money back, and they got to be responsible at how they invest that money. So sometimes they invest it like in First Republic in interest-only mortgages, or startups or tech like you saw in Silicon Valley Bank. So that's a huge thing. And then the Fed rate hikes this one will be the 10th time, by the way, that they raise it in May. So it's going to go from 4.75 to 5%, and then it's going to go up to 5 to 5.25, which is great. And we're going to still be in an inverted curve. And historically wise, when you see an inverted curve, it means that we are headed towards a recession, right? You want a regular curve. Well, let me explain it. When interest rates on the short term are higher than the long term, traditionally wise, it means that in a recession is heading. Interest rates on the short term are supposed to be less. They are in the long term for holding your money, because since you're allowing them to hold your money longer, those rates are supposed to be higher for you to take that additional risk, which is a huge thing. So let's talk about this recession watch, right? I talk about recession, we keep hearing about recession, but the debate continues in the U.S. economy if we will fall in recession in 2023. I heard watching Bloomberg today. I'm hearing about recession and stagflation. Aggressive Fed rate hikes and inverted yield curve points out an impending economic slowdown, right? But other data such as employment numbers and positive GDP says otherwise. right? So when we traditionally have a recession, one of the biggest things that we dictate recession with is negative 2 quarters of negative GDP. We have not had that. We're still seeing people who are hiring right now. We see positive GDP, right? But when you look at the Wall Street poll, most economists think that we're going to be a recession within the next 12 months. And that's about 61% of them think that. Right now, that we are seeing more layoffs right now. We see contraction in the job market, which will surely increase unemployment numbers. But the possible extent duration of potential recession remains difficult to gauge as a conflict, right? So that's where we are for that, for as a recession watch. But now let's talk about real estate. So last month, right, we found the national numbers. U.S. now average home is 375,700, a drop of 0.9% from a year ago, with some markets seeing more significant price drops than others. The Bay Area is one of the hardest hit places right now when it comes to real estate. And the reason being is the stock options has drastically stopped for a lot of these tech companies. And those people are looking at the cost of service debt. Those people are worried about jobs at the tech industry. So they're very, very concerned right now about their jobs. And then you look at how much it costs to borrow money. A lot of people simply cannot afford a home right now in the Bay Area with home prices with this huge boom. And what's interesting is a lot of people say, forget it. If I can't rent it for it, I don't want to sell my house again. I'm simply not going to sell it. I'm going to keep my house in my name. I was listening to one guy today. He said, I have a less than 3% interest only loan with the First Republic Bank. I am not going to sell my house in the next 30 years because this is going to be the cheapest money I ever borrow. And that's where we are right now. But sales are down almost universally existing, right? So they're down for nationally wise 22% over the last 12 months. The western part of the country is down about 30%, right? And a lack of home sales continue to define our market with only 2.6 months supply, which at the end of March. While that is a 1% improvement from February 23rd, but it's 5.4% higher than 2022. And this is what is interesting, right? And here in the Bay Area, let's talk about Oakland, where my office is. One of the biggest revenue generating things for cities is transfer tax. And what I just told you is home sales are drastically slow, and transfer tax is a huge thing. So yesterday, the mayor announced there's going to be, they have a huge budget shortfall for the city of Oakland. Office space, right? This is talking about residential, but office space in San Francisco is having a huge amount of emptiness, which means going to be less revenue for these cities. And right now, as cities are having more and more cities, crime is up nationwide. We have a homeless issue on the West Coast. This is very, very significant that this loss of revenue is going to be because it won't be adequate enough for these cities and counties to service that debt, which is very, very interesting on what's going to happen next. I see Oakland need more police, but instead of getting more police, the mayor said that they might have to cut positions or not hire positions that they need during this period of time. Also, right now, what we see when we go back into the housing thing before my spinoff is that mortgage rates are continuing their volatility ride as well. As we have seen right now that the 30-year mortgage is at 6.39%. It has been very volatile for mortgage rates. It's been very, very interesting during that period of time, right? So we're going to see during this period of time what's going to happen next in the residential market, and then more importantly, what's going to be happening in the office space, in the office commercial space, right? And because right now, when we look at real estate, people talking about residential, but what's the biggest killer right now is commercial office space, where companies simply didn't go back to work. Next thing, let's talk about market, right? People say time in the market, not time in the market. So everybody say, Jay, what can I do to get rich fast? I think that's the worst thing you can do. The key is not the timing, it's just the time in the market, right? We want to take advantage of compound interest. So we all heard the axiom, but why does it still rise for investors? Too often we respond economically to market volatility, dump our positions in response to sharp market drops or negative economic news. But that may be the exact time when you want to remain in the market. Right, according to research by JP Morgan Asset Management, the most significant market drops often closely follow large gains. In fact, missing the S&P 10 best trading day over the last 20 years will reduce your annual return by 4.2%. Think about that. There are numerous examples, statistical models that demonstrate this concept, but the list remains the same. Stay the course during time of volatility, and always remember the past performance does not dictate the future results. So this is a very important thing, right? And I tell this to one of my clients. I had a client today, where I talk about when we look at your investment in your portfolio, you're getting close towards retirement. We're going to need some of your money to cover your basic expenses, while we want some of your money to help you with your wants and your luxuries or your wishes in life. Your basic income will what we say when we do our portfolios for our clients, we want that money to be guaranteed to come in every single month on the first of every month. But when it comes to your other money, that money could ride the volatility because we just carried out we just can guarantee your monthly income for the rest of your life. The other rest of your money could ride that volatility wave. It can go up and down, up and down. Now, he was older, close to retirement. But if you're younger, you can ride the wave even longer because your time horizon, if you're in your 30s or 40s, is 40 or 30 years left. So remember that. Don't get caught up in the market. The market's not going to turn. Eventually it does. There's periods of times where the market doesn't do anything, and the periods of market time does. That's why it's important to have an advisor. Matthews Financial Insurance Solutions, Gibson Monroe Wealth Advisors, here to really help you out with that. And last but not least, I want to give you guys this quote, right? Economists are often asked to predict what the economy is going to do, but economic predictions require predicting what policies are going to do, and nothing is more predictable. Ooh, that's powerful. If you guys want any more information, if you want to get in touch with us, give me a phone call at 510-229-7608. Email is at matthewsfinancial@gmail.com or our website, mfis.biz.